This video is going to bridge the concepts of finally going over retail most of this bootcamp to finally going over to liquidity. Okay, and there's something that so when I started with naked price action at first, and then I kind of went to a phase where I'm like, oh, buy and sell indicator. Okay, where I just type in all these things and it tell me where to buy and sell. Newsflash, this doesn't work. Who the hell would buy and sell here? They'd get stopped out. Commissions would it doesn't work. Trust me. So I kind of went through that phase, and then I went through like if I line up 5 indicators, I'll be really profitable. Well, the 5 indicators almost never lined up, and even if they did, it wasn't perfect. And then I went to supply and demand. Okay, and I quickly realized I'm like, there's no precise way to buy and sell in a supply and demand zone. There's just it's too big of a zone to buy and sell off of. So I didn't like that either. And then I finally stumbled upon something called the strat. And yes, you heard it. It's literally just called the strat. Like this. Okay, it's not a generic term. This is what it's called. Okay. Now, the strat kind of is my first taste at kind of understanding where the market needed to go. About 2 years ago today, I have a Snapchat memory saved, and I learned something called the H pattern. And this to me was like groundbreaking because this was the first. So let me give you a little backstory. Learning this H pattern was the first taste of screen time I ever had. At this point, when I learned this, I had been trading for about 2 years, and I remember telling my buddy one day I saw SPY because I used to trade SPY, and because I traded options. I saw SPY, and I told my buddy, I'm like, oh my god, SPY is in this little. Let's see if I can find a good example. SPY is in this really H pattern. I've seen this before. And where does the H pattern complete? At low of day. And I didn't understand why the market had to go low of day. I didn't understand there were stop losses here. I didn't understand why the market moves the way it does. And now that we have gotten this far, you should understand by now that the market's only goal is to target stop losses and inefficiencies. Okay, which we'll go over the inefficiencies part later. But the market's goal is to target stop losses. So what does that mean? It means the market should go to low day here. And I was just trading a pattern. I didn't know why we had to go to low day, but I saw this pattern before, and I knew that SPY would likely go to low day. And that was my first ever taste of a light bulb in my head based off of screen time, because I had seen this pattern before, and I texted my buddy. I'm like, hey, dude, this looks like an H setting up. So we have to go back to low day. And that was the first ever play I took that had to do with screen time, not just playing the market and looking for a pattern. So it's kind of cool. So the H pattern just looks like a little H, and generally it completes at low a day. And again, it can be an inverse as well. It can be an inverse H pattern. But the really cool thing is, that's really when the market, like, this is the first kind of taste in when the market clicked for me, because I've seen it before. And the funny thing was, I didn't understand that the market had to go low day. I just knew it had to go low day because of the H, but not because of the science behind the H. The science behind the H was, where are people going to put their stop loss? Well, they're going to put their stop loss at low of day, high of day, because they think, oh, if SPY made a new low of day, we're not going to hit it again. And that's kind of the science behind everything. Okay. So that was kind of the first taste of, okay, I understand what liquidity is now. I understand why this is liquidity. I understand this is stop losses. All right. And it's kind of cool. I honestly just brought that memory back in my head. I got a Snapchat memory on my thing the other day, and I remember that was the first day where I honestly felt like, oh my god, I've traded so long where I know this should work. So it's just kind of cool. All right. So what is the strat? A strat is basically a candlestick pattern strategy. Okay. Now there's a little cheat sheet. Okay. If I pull it up, it's created by someone called Rob, and rest in peace to him. He did pass away, I think 3 or 4 months ago. Dude, I saw it on Twitter, so I did follow him on Twitter, and he did pass away. He had a very bad sickness, unfortunately. So, obviously, pray for his family. He has not been gone that long, but again, he was kind of the creator of this. Okay, his at was Rob in the black. Okay, and this is really cool. So why does this bridge the retail concepts to kind of ICT? Well, the strat is all based off the highs and lows. So if I just zoom in real quick, see if I can get this. I'm gonna pull this up probably in a different tab, honestly. So basically there's, again, this might be a little complicated to explain, but there's all these kind of patterns with candlesticks. Okay, so you got 3 different types of candles, 1, 2, and 3. All right, a 1 is a inside candle. So let me just explain what a 1 candlestick looks like. If you ever see a candle representing a 1, so I could actually pull up an indicator for this. Watch this. This is cool. That's too much. I'm going to see if I can get a cleaner one. Okay, that's good enough. A 1 is going to be an inside candle. So here's a good example right here. So do you see how this candle, this candle right here, it's a black candle. Do you see how the high of this candle, which if you look up here, look at these things. When my cursor's over this, see how the high of this candle, it says 18589.50, and it says the low is 18577.25. Now, why is that significant? Because both the high and low are inside of the candle previously. So the high here is 18593, and the low here is 18576.75. So the low of this candle is lower than this candle, and the high of this candle is also higher than this candle, making this a 1 and making this a 2. Okay, so this is just called an inside candle. It means the candle is inside the previous candle, and the high and low do not get traded above or below the previous candle. And with a strat, one of the patterns here was this. If we ever got an inside candle, let me just visually draw this out so it's just very easy to understand. If you ever got an inside candle, so this would be an inside candle because this candle's inside this candle. The second the next candle triggered above the higher low of the 2 candle, or the 1 candle, sorry. So this is the 1, this is the 2. The target or the pattern that you trade is you long here once we broke above, and you'd sell here. So you long this 1 candle, and then you'd sell up here. And that is one of the patterns of the strat. That's an inside candle breakout. So let me show you a few examples. So I can't really show you right now because replay mode just doesn't let me do it. But this is a 1 candle. So basically, when the next candle opens, I'm gonna buy if we break this line, and I'm gonna sell if we break this line. Okay, and what I'm gonna do is I'm going to sell at this line if it's a long, or if I sell here, I'll sell this line right here because it's the bottom of the candle. All right, so first things you notice is obviously this is not much of a take profit. This is very small. Same thing with this, but this is just how it worked. And remember, this is called magnitude. Like, this is magnitude. How many points is this? And remember, this is the 5-minute time frame. Imagine if this was on the daily time frame. If this was on the daily time frame, this would probably be a much bigger move and a much bigger magnitude. So honestly, this isn't the best risk to reward, but that's just how the strat worked, and that was kind of one of the patterns. So you can see that's called the 2-1-2 bearish and bullish reversal. So we get a 2 candle, a 1 candle, and then you see how the entry is when the 1 candle breaks, and that's kind of that. All right, so there's something called an outside candle, and that's the 3. Okay, that's going to be labeled as a 3. So the outside candle is all it is. It's a candle that trades outside of the high and low of the previous candle. So see how this is the 3. Why? Because when we go to the previous candle, okay, really weird drawing there. Look, this is the high, this is the low. See how price trades below it and above it? So that means this candle is now an outside candle. All right. And there's a couple patterns with outside candles. There's a 3-2-2 bearish reversal. It's literally the same thing as this, except there's just a different number. So this is a 3-2 right here. And what would need to happen is you'd short if this broke, but this never even broke. So let me see if I can find an example where it breaks. There's not, so you're going to notice the least amount of threes there is. Okay. I need a 3-2-2. Give me one moment here. Okay, so this would technically be an example. So in this example, we get a 3 candle, and then we get a 2 candle. And then, interesting enough, we get a 1 candle. So this is kind of a double whammy. Why? Because let's just pretend this candle wasn't here. I can't really block it out, but let's pretend that candle just wasn't there. Let me just send this to front. So let's just pretend that candle wasn't there, and we just get a 3, 2, and then another 2. Your entry would be if this broke. So if this low broke, I'd take a short there, and your target would be the bottom of the 3 candle. Okay, and you're going to understand why this is important to understand, because this is all based off liquidity, and I'll explain why in a second. But you can see that's just another pattern, and it's something to know. It's not a why thing. It's a pattern thing where you should just know it. It's like knowing 2 + 2 is 4. You should just know it. Same thing with this. You should just know, okay, 2, 1, here's the entry, here's the target, here's the stop loss. You should just know it. So take a second to study these. I'm not going to go over every single one, but again, you could use this indicator to kind of help you out a little bit, and as long as you understand a 3 is an outside candle, a 1 is an inside candle, and a 2 is just all the other candles, then you should be good. Remember, if it's not an outside or an inside candle, the 2 means it just broke the high or the low of the previous candle. So all this 2 means is we broke the high or the low of the candle. We didn't break both. So this candle's a 2 because we just broke this high. We never even broke this low. Okay. Now this wick almost broke the low, but did the wick actually break the low physically? Nope. So it's still 2. So again, you're going to study the sheet. Now, why is this bridging? Why is this so close to ICT, or how is this getting even closer? Well, when we think about candlesticks and how they work, let me just take this indicator off. Every single target of the strat is the next high or low. Okay, so if I just look for an inside candle, let me just turn the indicator back on. It kind of does help a little bit. It's just a little messy. Every single target is the high or low. So if I'm looking for an inside candle break, such as right here, where we get a 2 and then a 1. Why is the target the high? And why does the market have to go to this high once this breaks? It all has to do with stop losses, because people place their stop loss above that high, and all we're doing for the strat is buying the breakout to that high where people's stop losses are. So again, if I were to draw a candle right here, let me just change this setting real quick, and an inside candle here, and we break out of that inside candle, why is the market just not going to stop here typically? Well, the market's not going to stop here because it's almost like it's a mini wedge. See this? And if we go to the science of why wedges work, let me just type in Google. So if we go to the science and why does a wedge work? Why does a wedge go and hit the high? Okay. Or why does a wedge go and hit the low? Look at this. See how this arrow goes and hits the high? It just doesn't stop here at the breakout. It's because once we get that momentum, the market, like we said, is going to target the stop losses where the momentum is going. And because the stops weren't taken here or here, that's where the market's going to go, right? Because people are shorting this trend line. People think it's resistance, and it's not. They see, oh, we bounced up, we rejected this 50 times. I'm going to short it, but it's not resistance. They put their, and then where they put their stop losses? Well, they put their stop losses above the trend line because they're like, well, if I'm right, we shouldn't go above the trend line. So applying that to the strat, and why the strat works is because when we break that inside candle, we're stopping everyone out who shorts that candle, and it gives us enough boost to go back to the next candle high because of all the people who have to buy back their shares to get stopped out because they're all getting stopped out. So that's why, or the science behind kind of how it works. So again, if we go to another 3-1 candle, 3-1-2 breakout, I gotta find some real quick. Let's see here. Again, like I said, the 3-1-2 is kind of rare, but it does work well. Okay. So right, that's not one. And you can see how kind of rare these are. I might have missed one, but that's okay. All right, we're just going to go to a 2-1, I think. So we have a 2-1 here. That's fine. 2-1 is fine too. So we have a 2, and then we have a 1 because this is an inside candle, and we know the 1 represents the inside candle. Why does the market go to this high instead of stopping? Why doesn't the market just stop here and then go down? Well, because we broke an inside candle. This is where stop losses rest. So this stop loss here, the people stop loss here, are going to cause us to go to these stop losses here. And that's why it works. And you're just playing the momentum off it due to the strat. And this is the first concept that really bridges kind of liquidity and kind of retail together. And it's so cool. So this is one where this actually fails. And again, we know no strategy has a 100% win rate. But do you see how there's a 2 and then a 1? And we break that 1, so this would be a short entry right here. That would be your entry. But we don't hit the target. The target would be this low. And it just doesn't hit. So that's an example where it fails. But for the most part, what you're going to see is, like in this example here, if we break the high or low, the inside candle, we will generally, let me just do this in entry, go to that next high, that candle, okay, or even the candle previously. So I'd actually target this. Because, why? Because there's going to be stop losses here. They're going to cause people to stop out and buy back their position and put us back up at the next high. So this would be the entry when we break out of the inside candle. And because of liquidity and because of how the market works, it has to go back to the next high because the market is targeting stop losses. And that's where the most stop losses are based off of this breakout. Okay, and that's the most simple way to put it. And for anyone who doesn't understand, it's all based off of what the market's targeting. The market algorithm is targeting stop losses. This strategy has to do with targeting highs and lows, which is where people's stop losses are placed. So that's why it's so important to understand. There's a ton of different patterns. You can literally just type this in Google and look at these patterns. But as you know, I do not use a strat. I retired from the strat. I'm now officially an ICT trader. This is maybe good to look into, but you will have a much better time with ICT if you can understand ICT. Trust me. Okay. I didn't mind the strat, but the risk reward was horrible. This is the problem with the strat. I haven't done the risk management video yet, but that will be soon. The problem with the strat is this. Look how horrible this risk reward is. Your entry is here, this breakout, and your stop loss is actually going to be below the low, the inside candle. So a stop loss would be here because obviously we know if the market broke there, it would want to target the lows because of liquidity. Then that would be your stop loss. But do you see how the risk reward is just really bad here? It's just 0.58. So although the strat will likely tell you the direction, especially in the higher time frame candles, it's not really good as an entry technique in my opinion. Okay. Um, like I said, you can use the strat for like higher time frame reversals. And it might tell you where we might go, but trust me when I say by the end of this boot camp, you will not be using the strat. You will not want to use the strat. It's just I think it's good to go over this because it was kind of the first thing that kind of made me understand or created that connection in my brain that, okay, we need to go to the higher low. That's where the market wants to go. And I don't know how to explain this in the best way possible, but once you have that connection in your brain that we need to go to a higher low, and keep in mind, it's not going to be like 100% of the time we're going to get this right. You will have to play stop losses. But once you see the market go to the higher low that you think it should go to based off of stop losses, that's when you're going to get the feeling of, wow, I actually knew that low was going to hit. Well, I knew that. Why? Because there are stop losses there. Where does the market target? Stop losses. And it creates that connection in your brain. And this is really the first strategy I ever used that kind of helped me build that connection because I saw us break these highs and lows and go to the next high and low so much that it really made me believe that there actually is an algorithm. I didn't really believe there was an algorithm before learning stuff like this because I didn't understand that the market had to hit the high or low. I was clueless. And this was really the first thing that created that connection in my brain. So that's just a little video on the strat. There's a lot of videos on YouTube going over more of these patterns. I do want to go over, there is something that I still will use from the strat called the broadening formation. And basically, it's basically when you kind of get this like megaphone pattern. Now, it happened on Friday, and so this is the 15-minute time frame. Okay. If you ever see this, it's basically a kind of broadening formation where we keep bouncing off like a broadening trend line. So a proper trend line is going to look like this. And then we're going to break it. Okay, this is what a proper trend line. But why do we not break it to the upside? Like people are wondering, why don't we just go like this? Why don't we break to the upside? Well, because we've already ran all the stop losses. Look, we've ran stops there already. We already ran the previous stop there. We're already running these stop losses. So there's no point in going to the upside. The market does not want to go to the upside. It wants to go to the downside because we haven't ran any of these stop losses, right? Do you see this stop loss getting ran here yet? Nope. We run it eventually, but it just never gets broken on the way up. All these stop losses have already been triggered up here. So you can see when we get that on both sides of the market where stop losses have been ran at the highs and stop losses are ran at the lows, it makes for a really, really bad trading session because price will just chop. So this is a pattern you should know and recognize, and just know, be very, very careful when you see this. If I'm ever going, and I'm going to explain this in the kill zone video, but if you're ever going into like the New York session, such as 9:30, and you already see this form during London, such as like this was at 8:45 a.m. So the 9:30 or the stock market had open here. If you ever see this going into the 9:30 session, price is probably going to be trash. So just make sure you're looking out for this before you go into the session and make sure you're not getting caught up in this. And if you're like ever in a short, such as like here, let's say I'm in the short right here. It is very risky targeting lower than this line here. You mostly want to get out if you ever see something here because I know the bias might still be bearish. I know we probably may go lower eventually. Price will just stall here and you're going to see that happen and you're going to get stopped out eventually. So be very careful if you ever see this. Scale more than usual or get out some of your position more than usual. And yeah, just be mindful of this. So this is called just a broadening formation. It's something you should definitely know and have in your toolkit to recognize because it will tell you when the AM session is going to be trash or the New York session, which I'll go over in another video. So That's going to be it for this video. Let me know if you guys have any questions, and I'll see you guys later. Peace.